Hello traders, we are starting our educational stream. Today we will make some new, I think that's okay. I hope you hear me well. We're waiting for for several seconds. Great, we can start, I think. So hi again traders, nice to broadcast for you again. Today we have crucial topic for discussion, namely the nature of consolidation. It's important to understand the nature of consolidations and flats in the market. Flat is or consolidation, absolutely the same terms. It means the range between two levels, a local efficiency, local market efficiency, a kind of side movement, as you see, when the price is going inside a narrow or quite broad range, like this or like this. Sorry, just a moment. Like that. Okay. It's important to understand the nature, as I said, because consolidation is market efficiency, and as you know, it's a local equality of supply and demand, or local lack of interest in the coin from participants. So let's write it down just to distinguish two reasons. Here we have the consolidation, as you see, and the first reason for consolidation is equality between supply and demand. I think it's clear. Or lack of interest. Lack of interest or lack of participants, the effect the same. Another reason for consolidation is the manipulation of a huge player. Huge player manipulation. Huge player manipulation. As you know from maybe as you know from previous videos, I really recommend you to watch them. The main reason for such manipulations is the loading of large capital. Loading of large capital. If a major participant wants to purchase futures contracts worth 500 million, just imagine, he will do so for a very long time due to the lack of a sufficient number of market sellers in a particular period of time. Just here and right now, there is a lack of liquidity to execute $500 million position. I think you understand. It would be more reasonable to show you another example, because this example we will use to explain market efficiency due to local equality of supply and demand. Here, this is the ideal situation of another reason, huge player loading. So, moreover, a long loading, as you see, as you understand, when the player is huge player is inside consolidation, he's trying to load his position because he is grabbing some liquidity because he needs a lot of this liquidity. But long loading is a gradual buying up of the instrument, which means the extraction of the local supply of the asset from the market, which of course obviously leads to a price increase. This is unprofitable for a large player, since the constant price increase when loading positions spoils the average entry point for this participant. The way out in this situation is to create a certain range, a diapason of a price movement, kind of this range, where the loading will be conducted, within which a large participant will be able to load for a long period of time and only then allow the price to exit this range, to break out with the subsequent closing of positions somewhere here. I think it's clear. If you have some questions, please ask. So how does a huge player create this range? How it's possible? The answer is by pulling some large fake limit orders here. I will show you. Let's draw down. Just imagine you are observing this not in the graph, but as well in order book. Here you have order book, for example, futures and spot, and you observe very interesting thing. Huge player pull some limit orders here. Limit orders on the both sides of this range. Especially it works on futures because on futures we have leverage. It means that we have an opportunity to put the limit orders for much bigger amount of contracts than we possess. So what do we have in I can place such a large limit order which will be perceived by market participants as a good obstacle from which one can enter a position and from which the price will bounce for sure. This sidebar is created, this range is created, in which a large participant is loading. Even having, I think, having about $20,000 or $40,000 on your deposit will give you opportunity by using huge leverage, placing such huge limit orders to be able to stop the price, to make price rebound from your limit order. In fact, when the price comes to this limit order, the huge player just hope for the reversal movement. If participants inside this range are strong enough, and start to execute this limit order. A huge player cancels it and cancel all this idea. And huge player usually organize all this scheme only in case he is much stronger than market participant, much stronger and have much more money than a market participant. And it will help him to manipulate the price. Just having this price inside this trap as long as he is loading the position. He just holds the price inside this range by pulling by placing these limit orders on both sides of this diapason of prices. That is quite preferable for him. But inside this range, he is continuing to buy here and here, pulling small limit orders inside, just letting them to be executed. And as soon as he is ready, as soon as he has loaded all the positions, in this case, it's for sale. He is selling. He is loading short position. As soon as he is done, he let the price to break the structure. He cancels all these limit orders and the price makes this movement. And then he's fixing there. So if there is a participant in the flat, then sooner or later he will break this market efficiency, and there will be this impulse for which he loaded. That was his final target, his final aim. This means that you and that we have noticed this process, and we will be able to earn on this moment. However, not every consolidation has the presence of a huge participant. Not every consolidation is the sign of a huge player. Sometimes it's just, as I said, local equality of market or market sluggishness. Just the local market efficiency. And how to distinguish one from the other. Let's talk about this. In this case, it's quite obvious. We see here the outcome. And by that, only by that, we assume that was the really huge player. There was the presence of the huge player inside it, because there was the result. And we have some signs of huge player. I will talk about this later. In this case, what do we have? We have the sluggish of the market, the weakness of the local movement, just the lack of participants. How to distinguish? First of all, let's start discussing it from this case. First of all, we have very small daily volume, 49 million against 200 or 100, or ideally it could be 200, starting from 200, as you see. Let's compare these two consolidations. MTL USDT, as you see, it really looks very, very weak, and we have very, very small, almost unreadable volume, with the daily volume 49 millions. Very, very low, and there is an obvious lack of volume. And here, what do we have here? Much more volume and much more daily volume. First of all, the second thing, here we have quite unpredictable price movement, unpredictable, and there is no logic in this price movement, as you see. the range, the borders of this range is not so clear, is not so readable and strict. But here you see very accurate borders. That means that on this border there was the support and resistance in the form of huge limit orders. Then finally, you can see these limit orders being pushed in the order book. They are quite huge, usually starting from $300,000 in contracts. I mean, in dollars. On both parts, it will be visible in the order book. In this case, there will be lack of activity. There will be no limit orders, and the order book will be almost static, not active. In this case, the order book will be active. Maybe there will be the robot. The automatic algorithm that is loading small limit orders, pushing it into the spread. Along with those limit orders that are stated in the borders. And finally, this active order book will result in even more active movement impulse. But here we see that there is no activity in the order book. There is no volume. There is no daily volume. And there is no logic in price movement. The borders are quite not so clear. And this is the sign of local weakness, of the local absence of market players. And this is just a consolidation. There will be no impulse. There will be no breakout from this structure. Here, yes, we have the breakout, but frankly speaking, it's looking more. It looks more like a news or reaction on the BTC. But we should skip such situation. On these situations, on this setup, we really see the presence of huge player, higher than average volumes, and the character of movement. In this case, I would probably participate in this movement. Then we have here the breakout, retest, and further movement. I think that was clear. I think that was quite interesting. And here also we have another interesting thing that can stress out the presence of huge player. Liquidity grabs. Here you have liquidity grabs. Small false breakout that helps huge player to load quicker, just due to the reach of stop losses of long participants. As you remember, the huge player is loading inside this small range. He lacks some liquidity, and here he initiates and provoke this outbreak, fake outbreak with the further price getting back, just to haunt these stop losses, just to load his position more quickly. This is another sign of huge player scheme, huge player trap. Now I think you will easily distinguish just local lack of interest or local equality between supply and demand from the real consolidation with a huge player loading with a potential breakout, from where you will be able to get really good profit. If you have some questions, please ask. That's all for today. Just a moment. I will check some questions from you. So great. If you have no questions, thank you for your attendance. It's extremely important for me that you're watching us. It gives us motivation to make the new content for you. So thank you and see you soon.